see in the context of the data drought? Does it make you inclined to stick with your plans as set out in September in the absence of the data that might
All right,
change
it
your
should be
mind,
live
or
now.
does it make you
Cool.
inclined to proceed with added caution because of uncertainty?
Yeah.
Still going here.
We'll
October
rephrase
29th,
that question, if we
2025,
face that question.
FOMC press conference.
It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the
Yeah, that's
job
bullshit.
market or any part of the economy is making a significant deterioration. Don't see that.
Yeah, the market needs them to say yes, it is. We're gonna cut. We're gonna cut.
You see big
It's been
companies
asking
making
for it for years.
either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low, and the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is the lower income workers that you're thinking
Not
about,
with your
or those
participation
that
rate
have their jobs
flatlining.
automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't. Our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the
Yeah, it
long
doesn't look too
recovery.
good there.
If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing. And as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it, and that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts,
Yeah, see, watching it in real time, you see how it kind of
we're trying to get to the end of this cycle.
might look bearish, but
place, and with
is it really?
On its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo
A
Finance.
lot of questions
Both
opened up
regional
here.
and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely.
Yeah, baby. This girl's the shit.
These loan losses and if it poses risks to the financial system or the outlook for the economy. Isn't it a warning sign?
J Pow Pow.
We're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions, but we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many
Yeah,
yourself have said
people
that
just
we're in a
default on their
bubble
fucking
economy
car
with
loans all the
thousands of
fucking time.
high-net-worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the
He's
lower end of
nervous.
income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But and you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
That wraps
Wow.
up the news conference from Chairman Powell.
A lot of
Following the decision
questions.
to reduce interest rates by 25 basis
A
points.
lot of
What about
questions.
the quarter?
And look at this
Tonight,
SOFR
TK
curve.
will be asking about financial conditions
They're
and
not
financial
good.
markets. If you are just joining us,
That's
welcome to the program.
2025. That's
Equities
December right there.
recovering. There was a drop off as soon as Chairman Powell started to speak. We're back to about negative 0.2% on the S&P. The bigger losses on the Russell, the small caps down by 0.8.
Those will probably get bid. Yeah, you see them getting bid in the back end.
At the front end of the curve by
They're getting bid.
9 to 10 basis points. A 25 basis
That'll be
point
the risk,
reduction
the uber
in
risk
the
trade.
two-way descent, the limited ability to guide from here, and these comments from the chairman
But
of the Federal
I
Reserve.
wouldn't go out
Take a
there and do
listen.
that.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. At a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
A December rate cut is far from a foregone conclusion. That was a prepared remark. It was scripted. TK, it was heavy with intent.
I love when they look down at the script. I mean, you wonder what percentage of the press conferences.
I think, to be honest with you, Tom, it gave it extra meaning. That was
absolutely.
the intent to come into this room and tell everybody, including Wall Street, we're not making a call on
Calm
December.
down. We're way down. And when we get to Torsten's Slock, I want to really dive into that. I need to frame this, John. I think it's so important. We've had this spectacular move lower in the 10-year.
Yeah, hedging hasn't come off since the meeting. That's when you know that it's more uncertainty getting baked in here.
On 2 standard deviations. We're by no means. Price has not cratered in the last 20 minutes.
Low end of the range for the year still. Totally with you. Bond market's been super well behaved. When the Fed last met back in September, 2s were near 350, 10s were near 4%. Right now, TK, 2s near 360. 10's near 4%.
There's going to be a lot of hyperventilation about this tomorrow. I'm also looking at the currency market, which I think is extraordinary, into the Trump-Xi meeting. And, it's a side story. I get it. It's not the Fed decides. It's maybe the president decides on trade. But it's a backstory to this that will be interesting in the next couple of days.
Dollar strength this afternoon. Euro dollar 115.82. Euro dollar down by 0.6%. TK mentioned it. Torsten Slock of Apollo with us around the table. Torsten, good afternoon. Good to see you. What's the big takeaway for you from that?
Well, that they do have clarity on the CPI, on the inflation side, but there was a lot of questions about the labor market, and it was very clear that he came into this saying the labor market is still chugging along, moving sideways, slightly cooling, and he didn't mention any of the private sector indicators, so he did basically say, we don't quite know exactly what's happening in the labor market, but we still feel quite good about it. So that's why he came to the conclusion, inflation is too high, the labor market is still okay. Therefore, there is no foregone conclusion about December.
How difficult is it to carry on cutting interest
Chairman
rates?
guy is funny.
It is very difficult because the labor market does have a number of indicators that are very important for this discussion. There is, of course, ADP, which we just got, and thankfully now it's weekly. If you just think about the number, 14,000 was the average weekly number for the last 4 weeks. If you multiply that by 4, you get some estimate of what that means on a monthly basis. That means that monthly job growth at the moment is in round numbers around 50,000. We just got a Fed paper a few weeks ago saying that the new equilibrium rate for non-farm payrolls is 30,000. So by that measure, the labor market is actually strong. In other words, job growth is stronger than what the Fed itself thinks that it should be in the long run, because 50 is higher than 30. And the conclusion therefore is, now you suddenly have that both the labor market is actually doing a little bit better than expected, and inflation is still at 3, which of course makes it very difficult for them to begin cutting again in December.
Let me follow up on that, though. Is that
Wow.
politically acceptable to have?
There's hundreds of basis points of cuts priced in here.
There's no way that plays.
See how it's backing away from 3%? He's like, ooh.
Number
We're at 4%, so I mean, not hundreds of basis points. We got
down from
75
200,000 last year to only 30,000 today,
out
which was
to
immigration has been
December of
slowing down significantly,
2026.
and the demographic headwinds also weighing on the overall number.
So anytime there's huge dips like this, I think
What is the level or the new
buying into
of their
cuts,
ex-post
which you
rate?
can do that
To
through
me,
long
they're
equities,
almost
long SOFR.
redefine a way. Did you hear forward guidance in
But
the press
it's
conference?
too early right now. This is going to get digested. If this moves sticks, then this will get digested and
Paint
sold
the
into
character,
equities.
Dr. Slock, of our ex-post nature now.
Well, the challenge also is not only did they not only mention forward guidance, but also he
It's
didn't
gonna be
talk about
fucking
data
brutal. You're gonna have to go
availability, because
Fed
that was
meeting to
the
Fed
biggest issue.
meeting,
And if you say,
and
well,
and if
then it looks like they're putting a
and
lot of data
once you
on
get
the
data
private
back, it'll
sector
be
data,
easier.
and he didn't mention some of the
Signaling
private
you'll
sector
be able
data
to
that actually is very important for the
front
labor
run a
market,
little
not
bit.
only ADP. There's also the, of course, Challenger Gray and Christmas
Oh, data.
announcements. There's also a new data from
Real,
Macro Edge
real
that
annoying.
also looks at job
John, and
growth
you love
announcements.
ISM.
There is also the ISM data that still
Yeah,
tells that the labor
Skew
market
is
is
headed
okay.
up.
There's also
I'm
LinkedIn
keeping these
job
puts.
openings. There's also Indeed job openings. There's also Paychecks, which is also looking at employment. All these indicators combined still tell a story of the labor market actually still hanging in there. So it's not the case that the labor market is falling out of bed. It's still the case that the labor market is okay. And combined with inflation at 3, remember the Fed's target is 2. So inflation is still way above the Fed's target. There is just not room to cut rates more, in particular not, as he also talked about, if you begin to worry about if
So
inflation
stupid
expectations begin to become entrenched.
because
So
it's
from
really
what you're
based
saying,
on the
based
fact
on
the stock
observations,
market's at
what I'm hearing
all-time
from you
highs.
is we've seen a
If it
steady
weren't,
climb in
then
payroll
probably
growth.
people
We
wouldn't
haven't
really
seen an
care
increase in
when you're
labor
making a
market
stink like
strength.
this.
Inflation is running at 3. Unemployment's still
Excuse
close
me.
to 4. GDP's tracking around 3% at the moment in this country. If that's the case, why did they just cut interest rates?
Well, his argument was also very, very carefully articulated, namely that we are trying to get closer to our star. So it's back to this, peculiar
Yeah, as
interest
soon as he
in that
said
there
more
is some
neutral,
very academic Kalman
market
filter
just
you can do
fucking
and figure out
ripped.
where is the level of interest rates where we should be, and say this was recalibrating monetary policy to that level. It really is a very, arm-wavy and academic discussion relative to what the actual data that you just listed. And if you add also the Atlanta Fed GDP now, almost 4% for last quarter. Where are we in terms of thinking about this slowdown? There is just not much sign of a slowdown when it comes to the real
Please
economy.
forgive the snark, but the way they talk about things like neutral and R-star, do these lights start flashing off in the FOMC room, in the boardroom, at the Federal Reserve? You've hit it. Well done, guys. Stop right there. What are they actually looking at to guide that decision?
Well, I do think that there is an intellectual camaraderie around R-star of saying, yeah, I know what you mean when you talk about R-star, and of course we got to get down to R-star. But the interesting thing about also this is that if you really are saying at the Dallas Fed that there is now a 30,000 non-farm payroll level, that actually means that R-star is actually lower.
John, Greg Ip has been wonderful about this. Where in God's name is the output gap right now? With Meta here in 25, 35 minutes, Google, and what we see tomorrow with Apple, Microsoft, the speech that NVIDIA gave the other day. Are you kidding me? We have no clue where the American output gap is.
Well, and that's why from a monetary policy perspective, it is really interesting, because if you look at the Magnificent Seven, they are all financed by equity prices being high. They're not sensitive to the Fed funds rate, whereas the S&P 493 is very sensitive to the Fed funds rate.
Is Apollo Global Management part of the Magnificent Seven?
They should be. They should be. Mike McKee was in the room. He was in the news conference. And Mike McKee, thank you for asking about financial conditions and financial markets. Mike McKee, what was the takeaway for you, sir?
Well, I think the absolute takeaway is that the Fed is probably going to pause in December unless there's some data that forces them to do another cut. There was a sort of almost Freudian slip by the chairman close to the end of the news conference when he said, if we cut again. And then he quickly backtracked and said, we will at some point. But I think that the mood of the committee now is we've done enough. Let's sit back and see what happens, especially without any data. And given the fact that inflation is still rising, you noted at the beginning when he was giving us the rundown of the economy, he said extrapolating the CPI into PCE suggests that it rose at 2.8%. Well, it was 2.7% in the prior reading. So it just shows you that inflation is still rising at a time when he had a hard time making a case that unemployment is a real problem. So I think the takeaway is don't expect much from the Fed in December unless the government gets back to work and we get some data that change their mind.
Michael McKee, you have covered the Federal Reserve for decades. Volcker through Greenspan, Bernanke, Yellen, the last compare. Mike, is the era of almighty Fed Chair dominance and power on the committee? Has it come to a close?
Well, I think that's another way of saying that I'm old, John, but I don't think it's come to a close. It's just changed a lot. When you had Paul Volcker, he was very firm in what he wanted to do, but he came in during a crisis, so he was able to marshal the troops to do that, and then they rebelled against him. Greenspan did it differently. He ran the Fed as if it were his own, and they did what basically he wanted them to do. But starting with Ben Bernanke and following with Janet Yellen and Jay Powell, it's become much more collegial. And the chair now is more in a situation where they are taking the temperature of everyone there and trying to figure out what the best consensus move would be.
Yeah, Lark got that real well.
That that's what members of the board
Yep.
and the Open Market Committee would like to see happen going forward. Don't know, given the names of various people who are among the finalists to replace Jay Powell, whether we would have an attempt to go back to the strong chairman view or whether we would still continue with consensus.
Can they wrestle control from that committee? Mike, thank you, sir. Fantastic work. You're not old. You're brilliant. Mike McKee there in DC.
That's why the British, they're so charming.
Come on,
you know, I mean.
But yes, maybe a little bit. More than me. Torsten, you're still with us. Torsten's Lock of Apollo, by the way, if you're just joining us. Torsten, Bob Michael of JP Morgan was on the program with me and TK earlier on this afternoon, and he made the case after this decision dropped and we saw the two-way dissent that the chairman was losing grip of this
You can see that moving average. Very helpful.
Well, it is a very unusual situation to have someone on the committee that thinks that rates should have been on hold, meaning that it would go in other direction than other members.
That is unusual.
Who thought that they should have been cutting. So it is a very challenging environment, of course, for whoever is the Fed chair and whoever walks in to be the next Fed chair to try to get a consensus on the committee. There is so much work that goes into, from the chair, whoever it is, to try to get a decision that is unanimous and that is a common ground and saying this is the way we're walking and this is the direction we're traveling. Now that there's more uncertainty about this, one reason why rates are going up is also because, well, maybe now Schmidt is not the only dissent. Maybe there are others that come around next time and say, well, maybe we should.
Yeah, maybe this is an anti-Trump type of thing.
We should be hiking. So that's why
yeah.
There was already a dot in the dot plot last time that said that rates should be going higher in December.
I think we know whose dot that was.
And now we know that that was Schmidt from the Kansas City Fed. So yes, it is becoming a much more challenging exercise. Normally, we just talk about inflation, unemployment, but this is no longer just about inflation, unemployment.
The heart of this, we got to get to Rosenberg, but the heart of this, John, is he's lame duck. That's all there is to it.
Totally agree, TK.
It's October. He's supposed to begin to be lame duck.
So let's fast forward to December. Just think about for a moment how much harder that's going to be. Put out forecasts, probably know who the new Fed chair is, how much power Chairman Powell can
HV got it
have,
very well.
Knowing who his replacement is potentially once we come around to May.
Yeah, I agree. And of course, as we've said 3-4 times today,
but just because that's flashing red doesn't mean you can just blindly short. Just saying that if you're already short, then you're in the right direction currently on that moving average, not on price. Price can go up to 7,000. I mean 7,000.
Seriously. Jeff Rosenberg, number one takeaway from that decision this afternoon.
Obviously, that would change the moving average.
Yeah,
moving average follows price. This guy's wicked annoying. Jeff Rosenberg.
Slow down when you're driving in the fog. It's interesting you guys were picking up on him reading in the notes and whether that was, very much pre-planned. I think what you see here is a repricing of market pricing to December. Going into this meeting, it was basically a foregone conclusion. It was 100%. When you come out of the meeting and you see the dissents on both sides and you recall the division within the committee, you could say that that is an appropriate repricing to the realization that there's more two-sided risks to the Fed's decision than the market was pricing in. And perhaps that comment was engineered to kind of push that forward. Maybe it wasn't, but the reality is that's what the market reaction is, and you can see that that's a very reasonable reaction to what we saw from the committee today.
I'm going to do an audible here. We got Torsten Slok and Jeffrey Rosenberg with us, and that is good and wonderful with their financial and economic knowledge. Torsten, you have a blistering sentence in your note of your concerns over private credit. I would suggest for global Wall Street, into the next Fed meeting and beyond, there's going to be further challenges here about the opaqueness in private credit. With you, with all of your resources at Apollo Global Management, how blind are we to where we're heading in the pricing of private credit?
That discussion is totally misguided. In public markets, I can get something that's safe. I can get something that's risky. In private markets, I can get something that's safe, I can get something that's risky. So there is no difference. It really is all about, do you want a risky investment? Do you want a safe investment? Something in the public market is investment grade, something in the private market is investment grade. So this discussion around what's happened in the last few weeks, yes, there might be a few cockroaches in the sense that there have certainly been some things that have been going under, but interestingly enough, those were basically all broadly syndicated loans, meaning these were things that were trading tick by tick, minute by minute in the public market. So why is the discussion about what's happening in private credit relevant for this? These were cockroaches in the public market that showed up in public balance
Jeff Rosenberg, will this affect the Fed? I mean, it's just as simple as that. If we
Look at him. He's talking his book. Guys from Apollo. I'll show you Apollo. Where's Apollo?
Well, it gets back to some of the earlier comments about,
I lost my chart.
On financial conditions. Yes. And, to what extent does financial conditions sort of factor
Yeah,
into
Apollo
the
right
decision?
here.
And I think
Guy's talking his book.
here, that financial conditions aren't really factoring into their decisions to cut rates.
Both these guys are private guys.
Carry the questions around interest rates and
Private
AI,
guys are the worst.
brushing them aside, saying AI financing has nothing to do with rates, which is true on a first order effect, but not necessarily on a second order effect, to the extent that interest rates broadly are creating very easy financial conditions, and they're contributing to the increase in financial conditions easing, especially that we saw since the Fed pivoted, to the labor market slowdown. That took us from, measurements that were sort of more optimistic to measurements that were kind of more on the euphoria side. But I think the asymmetry here is that the Fed will respond to tightening financial conditions after they're realized. To the earlier, interchange on, ex post and data dependence, this is a Fed that will be reactive. And I think what's very clear is the Fed's not really paying a lot of attention to financial conditions going into this cycle, but they will, as they have been, ever since the GFE, that they'll be very responsive if financial conditions for things that have nothing to do with the Fed end up tightening. The Fed will react into that with a massive cut in interest rates, restoration of zero interest rates, the forward guidance that you just talked about, balance sheet, all the tools that were once thought as kind of not normal are part of the normal playbook, but they'll be in reaction to something that is outside the Fed's control here and in a tightening of financial conditions.
Jeff, is that still a green light then? A bright green light just to stay long risk, stay long equities?
Well, it's a light that says you can't really predict that on a directional basis. The Fed is supportive here. That's part of, again, what we saw in kind of the movement in the metrics from optimism to euphoria around August, September. And the Fed's continuing to send that signal with market pricing coming down a bit, but basically pricing to normalization of 3%. And the expectation that under any circumstance where the Fed is faced with an outsize, and you heard in that last question right at the end, the Fed talking about the impact on consumption. This is understated. I mean, he said it in a very small way, but a large shock downward has a significant effect on consumption. And what was a little bit understated here is that the large increase in the wealth effect has been the support for consumption. It is why we're surprisingly strong. In addition to the lagged implementation and tariff inflation not being as worrisome, it was really the surge in the wealth effect and consumption that's leading to the upside surprise. But that has a double-edged sword to a larger decline. And that's, I think, the concern around financial conditions tightening.
Jeff, before you go, I promised I wouldn't mention Rick, but I think it's worth it. I've known Rick a long time. You've worked with him a long time. Can we just spend a second or something? Just how cool is it that Rick Riederbaum is associated with the Fed chair position?
It is very good for you to talk about that, and I look forward to hearing more from you on that subject, Jonathan.
Okay, Jeff Rosenberg of BlackRock. You avoid it, Jeff. You avoid it. I think it's fantastic.
I did.
To have someone like that.
To have the mix, absolutely.
It just makes the process all the more credible, which I imagine was the objective of the Treasury Secretary.
Mr. Reeder brings an entrepreneurial sense here that you don't get from grizzled economists. And
understands
the president
this market.
is to be hugely lauded for that with his secretary. Can I point out in the time we've got left something back to the late July meeting.
Sure.
Google, who we're going to hear from in 45 minutes, is up 42%.
Not bad.
We have to remember, I'm talking about the food lines in Chicago with Diane Swan. The roulette wheel is in full spin right now.
We've got about 60 seconds left. Programs like these traditionally obsess over what can go wrong. Torsten Slot, can we finish on what can go right? You put out a fantastic note in the last month about the economics profession needing to take a long, hard look in the mirror and just think about where we are compared to where they thought we would be, which is in a much worse place.
Absolutely. So the key issue was that Liberation Day is now 7 months ago. And we are still having a Fed chair that talks about the labor market is actually doing quite well. And we still have inflation above the target. I think that we have all been surprised, and of course the market has been surprised, and the economics profession has definitely been very surprised, that the textbook would have predicted a much more stagflationary shock, much more upside pressure on inflation, much more downside pressure on GDP. We have not seen that, and some would say yet. But this is the discussion, namely, do we still have that, as you just said, as a lagged effect in front of us? Or is this it? And then things are only getting better from here. And this is why what the Fed was doing today was exactly to say, so far, we have not seen that stagflationary shock that we expected in April after Liberation Day.
TK, we've been saying yet, it's not happened yet for a long time now, a number of years.
We have. We got to get the shutdown finished so we can get the data, because we're all blind. That's the number one thing.
Right now, we're waiting for earnings. An interesting meeting in the last hour or so. Torsten Slok of Apollo. Torsten, thank you, sir. The Federal Reserve reducing interest rates by 25 basis points. Dissent to both sides, and a very, very limited ability to guide.
Sorry about that. Try it working.
Equities attempting to turn around. The opening bow behind us, the closing bow 15 minutes away, and a ton of earnings still to come. From New York City, good afternoon.
Yeah, a ton of earnings to pick through. This market is not for the weak, let me tell you. Holy shit. You go from freaking see, nearly killing me. And go from Fed meeting. Now we got stacked earnings calendar. Let's pull it up here. Let's see what we find. Fucking A. Sorry about that. Having to deal with my freaking coughing. That is brutal. Alright, screeners. Let's see. I don't know why I don't see any of these tech names, but I know I have a chart. AMD is Tuesday, November 4th, so next Tuesday. The Google is today. At the bell, Google. Free cash flow. They're spending all that on AI. Free cash flow margin. Microsoft too. Yeah. Apple tomorrow. Gold futures never. Tesla already. Bang. All right. So had the presser, and wasn't the best moves. I mean, saw some vol expansion. We actually saw people taking off hedges prior to the meeting, which I thought was kind of abnormal. Um, which that kind of coincided with the rally that we saw prior to the rally. To the conference. But yeah, we have been seeing hedging coming down, and we are seeing vol coming down as well. So if there's going to be like some type of big time bearish case, we did see that reaction, and that reaction should be noted. That in terms of the Fed kind of side of things, that market is negative towards that. Now, how much of this rally has been based on the Fed, you will never know. I will never know. Is the market looking for lower rates? It's always looking. It doesn't want to have to pay incur interest costs, so preferably yes. All else things being equal. But yeah, if this is what we're going to have to do from meeting to meeting, are we going to get a cut? Are we not going to get a cut? Then market's not going to be as prepared to rally. Moon mode that we just saw, because I thought we were going to get, to be honest, at one point, the way the market was reacting, I thought we were going to get QE. I thought literally they're going to be like, yep, we're going to start buying up, and what he said there was not that. So either he doesn't think things are that bad, where they don't need to cut, or I'm blanking on that, because I don't even really know. If they're gonna postpone the cuts, push them out again. That's what's been happening, is it's been being pushed out. But how many more cuts they actually have? I think they got about. They should be getting closer to 2%. Right now we're at 4%, so they should have another 8 cuts. So maybe you see it over here, like this. These are the dip buyers. My computer's not liking that. Are they buying the dip on the long end? No, they're not. You can see it. So they're just buying the dip on the old indexes. But we are seeing hedging increasing. That does need to be noted. And yeah, VIX is still heading up. I think there's gonna be a lot of PMs here that are gonna be hedging their books here until we get some more clarity on the Fed. We thought we had a good cutting regime baked in here.
Right now, where they can really power through a lot of uncertainties from a macro perspective in whatever the Fed decides decides to do as far as interest rates are concerned.
Angelo, we want to get into those specific companies, but just real quickly, Jay Powell, that is, asked about the AI-related spend and said, by cutting rates, might there even be more spending? And then maybe, could this lead to, a bubble, essentially? He said he didn't think these investments are particularly interest rate sensitive. Do you agree? Is that correct?
I do agree with that. Yeah. I mean, I think it's going to be, at the end of the day, I mean, these companies have, whatever, CapEx plans in place that they're going to plan. And to be honest with you, they're already making allocations today for whatever they plan to do 2 years from now in 2027. So, I don't think a change in interest rate is really going to dictate anything in terms of the plans for these mega cap tech companies or even some of the tier 2 companies. It's really going to be dictated on what the actual demand landscape for AI is going to look like here in the foreseeable future.
Having said that AI spend, nobody does it better than NVIDIA and hooking up relationships. $5 trillion, first company to ever do that. Justifiable in your view?
Yeah, I mean, absolutely. I hate saying this, but I mean, and I don't want to call it still cheap, but I mean, I would say at the very least, the valuations here still look very reasonable for NVIDIA. I mean, you look at what they announced just yesterday at their GTC DC event, and really that 500 billion in bookings was really eye-popping, and I think exceeded what most expectations were out there. I think consensus street estimates remain now way too low, and I think the street has caught on to it, and they're going to continue to bid up the shares here looking ahead. And again, I don't think there is any reason to think that bookings growth will slow down here in the foreseeable future, as we think you'll continue to see that momentum going right into 2027 and 28.
All right, well, before we get to 2027 and 2028, we got to get through what's going on today. And that, of course, has to do with Alphabet, Meta Platforms, and Microsoft among the companies reporting today. I'm going to let you choose where you want to go. The most important one, in your view, we need to keep an eye on, and why.
Yeah, I mean, listen, I'd say theme-wise, right, it's going to probably be, dictated more so on the cloud than it is on the digital ad side. I think, we have a good indication of what's going on in terms of, the digital ad market, but I think really what's driving, some of the powering the AI investments more so than anything is what's going on in the cloud. And because of that, you need to hear from what Microsoft has to say. Azure grew, 39% here in the June quarter. Our view is you're still going to get high 30s growth here for the September quarter, and a similar guide for the December quarter. So I think really that's going to be key. I think you want to also hear what Alphabet has to say about their cloud business as well, as we're looking about 32% growth.
Hey, was the outage last week at AWS, is that an opportunity for Microsoft to get share?
It's tough to say. I mean, we're not looking at it like that, but it'll be definitely interesting to see what both Amazon and Microsoft have to say about these outages that we've seen.
Hey, just real quickly, 30 seconds. Which of the Mag 7 are you most confident about at this point? We've got, of course, Amazon and Apple tomorrow, and forgive me, just about 30 seconds, but which one do you like or feel most confident about?
I mean, if we're going all the way across the Mag 7, we're highly confident on NVIDIA. But as far as the ones reporting here, I mean, we do like Microsoft a lot, and that's not necessarily based on this quarter. This is a company where we think they'll more than double their revenue here over the next 7 years, and it's going to be powered by that Azure business. And as a result, we think they're going to find new ways to monetize the platform, and we just overall really like this story there. It's probably our highest conviction call. But that said, it's anyone's guess on what's going to happen in any given quarter.
Come back soon. Angelo Zeno over at CFRA Research. Folks, do not go anywhere. Lots of big earnings to come. We're heading over to our TV colleagues. The closing bell starts now.
Yeah, VIX is still catching a bid here. It's keeping me long these puts, but growing less confident by the minute.
Bloomberg's comprehensive cross-platform
Are other things rallying here?
Starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Masser, Tim Stenovic, they're in the radio booth.
Yeah, this is kind of, I mean, intraday shit here.
Very busy afternoon. A lot of things
Closing
going
bell.
on there. A potential détente in the U.S.-China trade wars. A Fed meeting that actually surprised in a rare sort of move. And of course, a slew of earnings on tap just moments away.
Yeah, what an exciting day. And we've definitely seen a reset when it comes to the Treasury trade with, Jay Powell talking about the December meeting. So much was expected in terms of another rate cut come December. Angelo Zeno was just on with us. CFRA Research covers the big tech names. He says it's a great place for big tech. Even with what we got from the Fed today, he's not worried about the environment. He said there's challenges outside of big tech, and even addressed what Jay Powell was asked about in terms of the AI spend. And again, he agreed with what Jay Powell said. This area, higher rates or lower rates or whatever, not a problem.
He's also saying, hey, NVIDIA's pretty reasonably valued at $5 trillion. NVIDIA hitting a $5 trillion market cap for the first time today, of course, but
yeah, I was going to say, did he exactly say that?
He did say that.
Yeah,
he did.
Yeah.
Still a deal.
He's blown away by the number we got from the GTC event.
$500 billion.
Yeah. So.
Yeah. Well,
I thought it was interesting too. He said that, this AI spend, it's not like the 1990s tech bubble because these companies have earnings. So we should point out some of these companies have earnings. Of course, there's a lot of players in this space here that have not shown a whole lot of anything. We are going to see some of those cards put on the table in just a matter of moments. We're expecting earnings out of Meta, out of Microsoft, out of Alphabet, and that's just in the tech space. Also expecting Carvana, Starbucks, Chipotle.
Oh, Carvana.
As we get the closing bells here in New York.
Carvana's reporting.
Line between gains and losses. I'm just going to call it right now, unchanged on the day, but it does look like it could potentially, maybe, finish in the green or maybe not. The Dow Jones Industrial Average is decidedly down more than 70 points or 0.1%. The NASDAQ is going to finish firmly in the green, up about 130 points or 0.6%. The S&P 500, we'll call it now, it is going to end the day in the red, so no record high for that. And the Russell 2000 down another day, 0.9%.
Yeah, looking at the S&P 500, most names in that index, folks, lower today. 378 losing some ground today, Katie. 124 to the upside and one unchanged.
Yeah, super narrow there. Let's take a look at the sector, and let's take a look at the circle and see what our friend is saying there. You can see that tech did manage to finish in the green, actually as a sector overall, up by about 1%. All eyes on NVIDIA. Communication services, which is pretty much tech in disguise, also rallying strong today. Energy industrials catching a little bit of a bid. What didn't do too well, you would guess this would be the case. Real
Little
estate
slip
down
up.
by
That happens to everybody.
2.7%. We saw a big pop in yields as Jerome Powell was speaking, and that certainly hit that sector pretty hard.
All right, real quickly, NVIDIA, got to mention, $5 trillion market cap today. The stock up as much as 5.5% earlier in the day, still finishing with a gain of about 3%. Historic $5 trillion market cap. We know we got a lot of big headlines from the company and its CEO, Jensen, yesterday. Just the AI spend, the AI frenzy, and we know how important this name is certainly to the bull market that we've seen. With a 50% gain this year through yesterday's close, the stock is single-handedly responsible for nearly a fifth of the S&P 500's index, 17% advance this year. So we know it's been really driving the trade. Teradyne, just got to mention, this was definitely a top gainer in the S&P 500, up 20% in today's session. I believe it's a record.
Rest in peace to my short.
Manufacturing company. Third quarter results beat expectations, and it gave an outlook well ahead of analyst consensus. It also named Michelle Turner its chief financial officer effective November 3rd. That stock up 40%. And Caterpillar up 11%, also an outperformer today.
Is this an AI play now, I'm told? Is Caterpillar an AI play?
No, isn't it nice? We got Alphabet.
All right. Well, speaking of AI, yeah, Alphabet earnings are out. EPS coming in. Looks like a pretty big beat. $2.87 a share for the most recent quarter. The street was looking for $2.26. Revenue in the most recent quarter also a beat. $102 billion in change. The street on average was looking for roughly about $99.9 billion. The company also says that it ended the quarter, that Google Cloud, I should say, ended the quarter, get this, guys, $155 billion backlog.
Ooh, yeah, certainly raises the stakes, too, for Amazon. A lot of focus on that cloud business. You can see Alphabet shares deciding what to do, moving higher right now. I will say, Tim, that the bar was high for Alphabet specifically. You think about where the stock has gone year to date, up by 45%, but clearly you can see investors parsing through and deciding what to do.
Yeah, bouncing around a little bit, but firmly higher now, about 3%. Sundar Pichai, the CEO, out saying that the company had a terrific quarter, double-digit growth across every major part of the business, calling out the first ever $100 billion quarter. He also called out Gemini. It now processes 7 billion tokens per minute and alludes to the full-stack approach to AI at Google that's delivering strong momentum, shipping at speed, including the global rollout of AI overviews and AI mode. in search in record time. Shares now up by about, wow, 4%.
All right, from one hyperscaler to another we go. Let's go to Microsoft, folks, just crossing with its numbers. First quarter intelligence cloud revenue, this is what we care about, $30.9 billion. The estimate on the street was $30.18 billion, so it looks like it's coming in line. First quarter Azure also important. Another cloud revenue, X currency, up 39%. That beats the estimate of a gain of about 37.1%. And first quarter revenue, again, a beat, $77.67 billion. The estimate on the street remained $75.55 billion. And yet we're seeing the stock down about 4% here in the aftermarket. So we'll look for some more color on this one.
Yeah, some of these numbers, while certainly a beat with regards to the average of analyst estimates that were public, it looks like they did come in below some of the whisper estimates that Bloomberg had reported on. But it gets to this idea as well, and we always have to wait with Microsoft to actually get any sort of forward guidance a little bit later. But this idea of exactly what is in the pipeline that they can actually sort of deliver, or at least flag to investors, that could sort of be a signal here that not just the spend on Microsoft's part, but more importantly, the reciprocity is actually still there.
Yeah, absolutely. Maybe we'll get some more detail about the pipeline when it comes to the earnings call, but you can see, again, those shares holding the after-hours decline of about 4%. And we know it was a big week for Microsoft with that OpenAI restructuring. Microsoft, of course, securing a stake here when it comes to the future, at least through 2032, Tim.
All right, I'm taking a look at Starbucks, ticker SB.
290. Holy fuck.
With earnings as we speak. Fourth quarter China comp sales up 2%. The estimate was for 2.16%. Fourth quarter comp sales up 1% to beat estimates of just about negative half a percentage point. Fourth quarter net revenue coming in above estimates at $9.6 billion. Fourth quarter adjusted earnings per share coming in shy of estimates at 52 cents. Fourth quarter North America comp sales, they were flat. The estimate was for a decline of half a percentage point. Fourth quarter adjusted operating margin up 9.4%. The estimate was for 10.2%, so that came in below estimates. Starbucks shares up about 1.6% now in the after hours.
All right, so let's get to Meta, because we're seeing the stock drop about 3.9% here in the aftermarket. Meta, with the outlook, sees fourth quarter revenue 56 to 59 billion. The estimate on the street is 57.38 billion. Fourth quarter 2025, or fourth quarter revenue. Let me go there because we're red heading that one here at the Bloomberg. Meta seeing fourth quarter revenue 56 to 59 billion, estimate 57.38 billion. Again, the stock down about 5%. Sees fourth quarter total revenue to be in the range, again, of 56.59. Keep reading the same ones as they come up. Looking at the past quarter, third quarter ad revenue was 50 billion. That's a beat. The street was looking for 48.59 billion. Third quarter EPS, $1.05 versus 6.3 a share. That's year over year. So we'll look for some color on that one. And then just looking at, go ahead, Ramit.
I just also want to point out, too, here, just going through the release here, there does appear to be a pretty large charge that the company took in the most recent quarter. This is a non-cash income tax charge of $15.93 billion. Meta, though, does say this is a one-off event, and I just want to be very precise in the language here, and that they do still see their fourth quarter 2025 tax rate in the range of 12 to 15%, which would be in line with what the street was looking for. But that does appear to be where we're getting some of the reaction, and one of the reasons why you did see a little bit of softness in that bottom line number for the quarter that just was. Let me just dive a little bit deeper into it and try to get you some more details.
Yeah, we'll continue to follow that, but as Romain said, could explain some of the negative reaction that we're seeing right now. Meta shares now down by more than 7%. I do want to go to this line in the release. We have a lot of focus, of course, when it comes to CapEx. Meta, they expect full year 2025 total expenses to now be in the range of 116 to 118 billion. The prior outlook had been for 114 to 118 billion there. And they also say that our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than in 2025. This has really been the story for a lot of these big seven names, but also for Meta particularly.
Sorry, I do want to go back to that tax issue here with Meta, and this is something that Zuckerberg and his team are going to have to address on the call. They talk about the One Big Beautiful Bill, basically the big budget stimulus that was passed earlier this year. They did say that they expect a significant reduction in their federal cash tax payments for the rest of the year because of that bill. However, they're saying that for the quarter that just passed, they had to recognize a valuation allowance change that basically amounted to a $16 billion charge. Again, they are saying that this is a one-time charge and then effectively they will revert back to something that actually a little bit less with regards to the effective tax rate for the current quarter, the current fourth quarter that we're in.
Yeah, the company continues on there. Romain says net income would have increased by 15.93 billion to 18.64 billion compared to the reported net income of 2.71 billion dollars. The company also saying, Mark Zuckerberg specifically saying that leading the industry when it comes to AI glasses, which we know that, and he sees a big opportunity there. A lot of analysts see a big opportunity there. He says if we deliver even a fraction of the opportunity ahead, then the next few years will be the most exciting period in our history.
All right. Well, those are some big words, but let's tear our eyes away from Meta for just a moment and talk about eBay.
Sounds like a fucking fraudster. Yeah, these glasses, man. Nobody's using them, but they're gonna be great.
Had been for $2.8 billion. So a bump up of that range. Take a look at shares down almost 9% at this point, though. So certainly some disappointment coming through when it comes to eBay.
Some disappointment as well when it comes to Carvana. Those shares down 10% in the after-hours trade with third quarter EPS coming in at $1.03 a share, revenue coming in at $5.65 billion. But here's your guidance. The company says that full-year EBITDA will be at least $2.2 billion. It had previously pretty much guided towards that. It had a range of $2 to $2.2 billion, so maybe potentially trying to nudge slightly above that with regards to expectations. We should point out, though, the company is also saying here with regards to retail unit sales, 155,941. We'll just round up to 156,000 here. Again, that did beat the average of analyst estimates, but there was a whisper number out there that was a little bit higher, maybe partly responsible for why you're seeing the shares down in the after-hours trade.
Yeah, costs and expenses too up about 32% year over year. Kurt Wagner, though, on our live blog talking about this net income and how we see this shortage and then attributing it to this one-time tax charge. Definitely a lot of questions on what this is because it does feel like it's come out of nowhere.
Sorry, one quick
15 billion.
The wire right now. Adjusted EPS coming in line with estimates at 29 cents a share. Revenue roughly coming in line with estimates at $3 billion. Comp sales lower than estimated, coming in at 0.3%. The street was looking for a gain of about 1% here. So a little bit light with regards to comp sales growth. Also a little bit light when it comes to operating margin, 15.9%. The street was looking for 16.6.
And while we're here, let's just talk about ServiceNow really quickly. Boosting their full-year subscription revenue forecast, also beating estimates.
Yeah, we can probably see that.
When it comes to the look back, subscription revenue now seen between $12.84 billion to $12.85 billion. The previous guide was for $12.78 billion to $12.8 billion. So you can see, of course, a little bit of a boost there to ServiceNow when it comes to that full-year subscription revenue.
All right, so Microsoft down 3.3%. You've got Alphabet up about 3.5%, and you've got Meta down about 5.7%. So those are big ones that we'll keep a watch on as we go into those calls with analysts and investors. Folks, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, Katie and Romain continuing there on the close on BTV. And right here on radio, Tim and I continuing on Bloomberg Business Week Daily as we continue to digest this earnings drop on this Fed Wednesday. We'll see you again, same time.
Fed Wednesday.
Tomorrow.
Peace, Carol.
There's a number in the market's collective head, and they don't exceed it, even if it's a beat, it can be seen as a negative thing. Or maybe they pull back guidance a little bit. We'll have to see. Maybe they'll dig into the conference call more detail, but yeah, interesting, ominous results here. And none of these are.
But also not universal because Google, in other words, you can't even make it a Mag 7 crisis. It's more, it sounds like the best explanation I've heard so far is that it's some version of an expectations crisis.
Yeah.
It certainly seems that way. I think
more than it is, because it sounds like the performance is pretty good, actually.
Yeah.
Yeah, I mean, I think if you look at Microsoft, like if you look at Meta, it's very easy to say, oh, well, that's a massive EPS miss. Okay, fine.
Yeah.
I understand what that is. And it's very easy to shrug that off and say, yeah, you know what? Obviously, this is a big miss. Okay, cool. One-off thing. This doesn't poison the well, as it were. This is one company having one issue. Okay, and it's idiosyncratic. But when you look at what Microsoft is doing here, I mean, their results, I haven't dug into them clearly. I'm just looking at the top line numbers here on the fly. But those top line numbers look pretty pretty good. I mean, there's nothing terrible here that I can see at first glance, and is getting cooked. So it's clearly not just a one-off meta thing that's only about meta.
Yeah, kind of a wild scenario we have here. It begs the question: what happens with Amazon and Apple tomorrow?
Yeah.
And you're seeing a little selling. You're seeing a little sympathy selling in Amazon, down 2 points after the close here, and in Apple we'll probably see the same thing, a little bit down, a couple of cents, a couple of shekels, nothing crazy. But Amazon,
it's not really spilling over into broader risk sentiment yet, which is going to be the other interesting thing. Like Bitcoin isn't really collapsing, the dollar isn't running away, so we'll see. But to your point, it's starting to spill a little.
yeah, ominous move indeed. Um,
and after the Fed did what they did.
Yeah. So what is your? So we were talking about today, looking at the CME FedWatch tool, as we always do. Staggering increase in probability.
As we do right about this time.
Yeah. Oh wow. So we've got
movement.
Okay, we got big movement. Okay, so a week ago, if we look at the December,
that's the one to look at.
Yep. So here we go. I can throw this on the screen here. So, oh, maybe not. All right, here we go. So this is what I'm looking at. So we had 1 week ago a 4% probability that we would stay at the current 25 basis point cut that was just announced.
Yeah.
Yesterday, that probability jumped from 4% to 9%. As of right now, today, this probability is now 34% that we stay. Wait, is this reflective of today's? No.
All right. So the current rate, as it presents itself currently, is 400 to 4.25 or 425 basis points. The pricing as it now appears is we are still likelier to get a cut narrowly in December, but the likelihood has significantly declined. So now we're looking at a 65% chance that we're going to get this cut from 375 or down to the 375 to 400 range. And the likelihood that we stay has increased from basically non-existent to 34%.
There we go.
It's kind of a mess.
Yes. And this was like 16% at 11 a.m. before he took the stand. So,
it was barely perceptible.
Yeah. So things have changed a little bit, shifting.
Yeah. Yes. Just when you thought, and I wrote about this and talked about it. I wrote about this for the blog and also talked about it on Macro Money yesterday. The two, of course, are the written and spoken version of the same idea. And it's this idea that we also discussed here on the show yesterday with Glenn, this idea that if everything is already priced for perfection as far as Fed policy is concerned, what is there to gain? Like, okay, Powell comes out, gives everybody the rate cut everybody thought. Cool.
Okay.
That's in the price.
I'm probably gonna move on.
What's there to gain?
I'm still gonna keep
There may be
these puts
nothing
open.
to gain from just realizing the expectations as they were, but everything
But
to
they're gonna be
lose
on a short leash because
even a little bit
I mean
something
it should be
off.
still
Powell did
bullish,
say something a little bit off.
but
He came out here and made a statement, and it couldn't have been clearer cut. Like he went out of.
but yeah, I mean guys like Ilya, he get fucking boners for shit like that. fucking gay. Um, and well, I mean, yeah, I mean, like, I mean, we did get some bearish, and usually it's not that big of a deal, but I mean, when you see bonds selling off like that, I mean, we really did have a lot of cuts priced in. We had QE priced in. We had this subprime blow up kind of coming to fruition, and Powell didn't give us a lot of that today. He said that things are still going well, and well, I mean, and that I mean we don't need emergency cuts, and we don't need it yet, and I mean for risk in a lot of ways, I mean that will be we pared back a little bit. I mean things were really bullish, and that's why I got out of my bonds position. I got out of my gold position, and I mean first asset I'm going to get back into is gold. I mean, and I mean, of course, so I mean, in terms of the short term scalping, um, so you look over here, yeah, with the even the EM Pro, this is a month. I mean, looking at fair value, I mean, 39.30 down to 38.25. So you're not getting that good of a deal buying over here. If you're on the monthly scale, which I mean, we're getting a new one pretty soon, but still, it doesn't matter. I mean, that's optimized. But looking at the weekly, I mean, yeah. So I mean, there's still room to be sold here, and well, that is another reason why I you know made made some good money off of that overnight, and rolled it into a different trade. And it's this long December put. I mean, it's a slow trade. I mean, and realistically, with these really slow trades, what you really have to realize is that they can. I mean, during this Fed conference, I mean, when I went down to 68.80, I was up like almost $100. I mean, that was a good position. I mean, and I could have sold out of it, and that would have been maybe prudent to do, and then re-enter. But there's transaction fees associated with that, um, and so Powell did give the Bears what they wanted. These earnings, I mean, that meta charge, I'll give some bear fuel. Um, and yeah, so I mean, markets are at all-time highs. So if they want to come down a couple, I mean, just use your expected move, and so 6,500 there. I mean, that would be crazy. I would look for like, I mean, 6,800. So things are going to be developing. There is both cases. I mean, bullish and bearish. I mean, there are I mean, drivers on both sides. I mean, and it definitely helps when you have the president himself on your side for the Bulls. But and realistically, for the Bulls, it's this odd paradox, and it takes, I mean, someone kind of more a nuanced perspective, or someone who really doesn't frankly care. Is that lower rates are good for a lot of for for a lot of trend following, a lot of I mean, just during those cuts, that's a lot of people tend to get bullish stock. It's a thematic trade. It's a reoccurring trade, and it's something that's been studied. And well, in order for that to happen, there needs to be labor market deterioration, um, and if there's more kind of stress in terms of credit, they might try to alleviate that also with cuts. So yeah, keep an eye on different conditions. Keep an eye on those things. Um, we even saw the 1 month yield getting backing up a little bit because it's been just going down. But yeah, in terms of I didn't see anything over the top today, but I mean, yeah, like looking at that SOFR, I mean that's really not good. Um, and yeah, equities are at all-time highs. So I mean, people do have an impetus here to put on a little bit of protection, and don't hear me yak 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 about it. Um, just look at vol. You know, you can do it yourself. You can do it too. And I mean, looking at this right here, I have a conspiracy theory, and it's going back. And the thing about conspiracy theories, what on earth is this? Can we merge on the right, please? Thank you. 4,000. I don't even know what that was. But like going back to here, I mean, we saw this huge vol increase, and that's what kind of made me bearish on stocks and whatnot. Is that the VIX came from this state of complacency, um, and really did explode higher, and it has been. I mean, there's been some real volatility. So I mean, the fact that the vol is still going back to here um, is something that and that did coincide with some funding market stresses. So I mean, so there is some factors here, and I mean, so I mean, should the VIX go down? I mean, business as usual. But I think maybe there'll be a little bit of an opportunity here, um, and well, yeah. So stay monitoring those types of things. The VIX, I mean, and implied volatilities and earnings, of course, and kind of the components of those investments that you may hold. But um, I think Trump still. I mean, long term, I think that this is just noise. I think the signal is that we're going to go even higher, and and I mean, I mean, honestly, like when on days like today, when I listen to Bloomberg and I hear um, Alphabet or Google, 100 billion, um, Meta, 50 billion, um, Microsoft, 75 billion. I mean, that's in a quarter in revenue, 75 billion. I mean, like though that's I mean really for us mere mortals, it's really it's tough to compute in a lot of ways, and I mean, so those companies are printing cash. So I mean, the signal is in a lot of ways is I mean, and you also have to say, okay, well, how much of that are they keeping, and when they keep that, what do they do with it? And that kind of greater plan. I mean, it is the basis for AI, in a lot of ways. Um, but yeah, I mean, it's a big bet, and I mean, yeah. So the course of travel, of course, is higher, but there are some signs here that are starting to mount. That I mean that we are on. I mean, we are on the edge, and that I mean, we could see a gold type of retracement where you see that volatility of um, of 10 or 15%. I mean, 20, but and that could be sustained. There could be some sustained selling, um, but again, these companies are earning 50 billion, 100 billion a quarter. That's I mean, what are you supposed to do? I mean, in, $100 billion a quarter. I mean, the run rate of $400 billion a year. I mean, like what? So then you go over here and you're like, what are you doing with your cash? Like thinking to yourself, I mean, what do you do with $100 billion in sales, right? And you're like you're earning 57 billion of that in gross profit. Like, I mean, like what? Like, They're turning over inventory 96 times. I mean, that's like, I mean, they're buying back over here, but and they're not buying back as much. But yeah. So I mean, what are they doing with? I mean, they have 50 billion in profit. 50 billion. Like I mean, like when you think about being a player, I mean, a market participant, and I mean, as a company, I mean, even if you're putting that in treasury bills, I mean, you could earn interest income. And I mean, that is just insane. So, I mean, the fact that it's up only isn't surprising in a lot of ways. And but you're looking at this gross profit here from 20 billion to 60 billion. I mean, what's going to take it from 60 to 180 billion a quarter? Um, because of course, yeah, this is. I mean, that's. I mean, that's amazing. I mean, but um, what's even better? I mean, it's low. Like it was like making this, and then gross profit went down to like 19 billion from August to 20. I mean, you don't want to be long gross profit, which I mean you do, up 200%, only 300%. That's interesting. Seems like maybe they could be doing something more with that. But yeah, Microsoft, Google, Meta just reported. Um, VIX actually got bid up. It's up 30 cents today. But mid 20% today. Yeah, it was hard. I mean, at some points I was up 50%, but I didn't pull out because I think we're on to something here. Maybe we could get a little bit of a pullback in these big names here. Maybe we see that gross profit number kind of stay stagnant. But I don't even really understand. There's, I mean, the mutual information of stock price and gross profit. But I'm not here to talk on that. But the thing is that I mean, yeah, we saw some bearish stuff today. Jay Powell today, but Trump, and I think that I mean the Fed governors, like that is something that is to be watched because I mean that could be really, I mean, like when you see it with gold, like gold was like betting on lower rates, like and that was the thing. It's like, oh, we're getting lower rates. Fuck yeah, party on, gold. Um, but now, I mean, it's like it's keeping things kind of buoyed a little bit here, which I mean, I think maybe they were trying to put out the asset price kind of rally a little bit with that presser. And where things are moving forward. And I think that's also just their dissatisfaction with Capitol Hill. But I think once they can get some more data, they can get back to their rate cutting biases. And we still have it's 96.91 right now, so that is implying a 3.1% yield. And in 2026, at the end of 2026, I mean, we could see that at 210. I mean, so at 90, 98. So I mean, with that comes a lot more of positive returns for equities. So party on for risk. But the way that we're going to get there could be kind of circular in a sense, and that's not going to be it's not going to just be a straight line getting there. There's going to have to be some type of um, sharp rise in unemployment and credit distress, and probably a mixture of both. And those things are related to those bankruptcies. Oh, and yeah, fuck, I didn't even see Carvana. And that I talked so much shit about the stock, right? So, um, if there were something, I mean, of course, people would take it upon themselves to sell the stock. And yeah, did I mean it's down eight handles. Yeah, that was a pretty good sell. So maybe we'll see some further selling there. Um, so yeah, I mean, interesting market here. Plenty of bullish cases and some bearish cases kind of popping up here. So till next time, appreciate the time. And as always, I'm not your guru 222 on a lot of different platforms. And the exceptional pleb. I mean, that's a great Discord. Come join, come be an exceptional pleb, and well, hopefully even change your life. And well, appreciate the time.